Good afternoon, everyone, and thanks for coming. Thanks for showing up, especially props to the people that came a little bit early. Vincent, I saw you checking in first. Good to see everybody here. Tonight, I'm going to be presenting on multi-unit investing in Southern California, specifically, different value add situations and covering just really the basics, scratching the surface. So my name is Tom Ahola. I'm an advisor, realtor, and multifamily specialist here at Marshall Reddick Real Estate. A little bit about myself. I've been with MR for about 2 years and some change now. I've been in real estate for a couple years before that. I do have my associates of real estate. Went and did my my degree in that. I didn't know it was a minor that I could have done, but I did. And I have a passion for education. I come from a family of educators. Teaching is very important to me. Nothing but patience for those that are here to learn. So as they say, there's no such thing as a silly question. If you have any questions, please, write them down. I won't be able to answer them in the webinar, but I will be able to go back and I can reply to you via email. So please be inquisitive, ask a ton of questions because we are going to be covering a ton of information. Okay. A little bit about Marshall Reddick. Some people here are Marshall Reddick clients. I know I personally talked to a couple people who are attending tonight that have been MR clients since the early 90s, and it's pretty cool to see the return clientele. However, for those of you that are new, we are Marshall Reddick Real Estate. We do real estate brokerage, sales. That's listing, buying, everything to do with that. Whether it's land, single family, multifamily, commercial, pretty much anything investment oriented. We 1031 exchange it state to state. We do a lot. Property management, which is crucial to any investment real estate, as well as private lending. A little mantra we got for you. We make it possible for all to safely and simply invest in real estate in carefully selected areas of the United States. Our firm provides education, investments, and in-house professional real estate services, along with access to other vetted and necessary resources such as contractors, lawyers, insurance agents, CPAs, you name it, we've got it. With MR being around for so many years, there's been many relationships built, and we definitely have everybody that you can possibly think of that you would need in a real estate investment portfolio planning. Okay. We operate in many different states, many states. We have brokerages with property management and leasing teams set up in Texas, Tennessee, Florida, California. We have a lot of referral partners, as well as, there's some states that are highlighted that I've done business in this year, but these are the main states that we do the majority of our businesses. Now for today, we are mostly going to be focusing on Southern California, Orange County and South LA County specifically, mainly because that's the majority of our reach. That is, we do have an office up in, Northern LA, but we mostly focus on Orange County, South LA, and, parts of LA. We try to avoid LA proper and Santa Monica, a couple places like that that are a little more tricky, but we actually do have a few properties we manage there, so we're educated. Continuing on, topics we will cover here tonight. Number one, why multifamily, why value add? What is the cap rate, or what is a cap rate rather? Buyer or seller representation, how to find 3 to 8 unit properties. Property management, I can't stress enough how important property management is in this whole transaction. Financing, as well as a recent case study. We're going to talk about a property that I actually sold in January with my partner, and we sold to one of our landlords, and we have proceeded to turn over 3 of the 4 units. So we'll look at the numbers on acquisition and where the building sits right now. I'm actually getting ready to lease one of the units as we speak. So if you know anybody looking for a 1-bedroom in the Huntington Harbor area, again, let me know. Okay, the big question, why multifamily, why value add? Now, I do know as well from a couple people that I spoke to, some of you already have multifamily, a lot of you don't. A lot of people are just recently looking to get into it. With the market forecast where it's headed, a lot of investment companies are switching to the multifamily approach. This is definitely a smart move. First and foremost, you have the economies of scale. Now, what does that mean? That means when rents go up, it's not just going up over 1 unit, it's going up over 4. And it's not just that you're buying, a single family residence. The property or the price per unit actually goes down the bigger the buildings get. So whereas a single family house in the neighborhood that I like to sell in is about $1.6 million, you can get a duplex for about 1.2. You can get a triplex for 1.6, about the same equivalent for a single family house, and you can get a fourplex for about 2.4. That when you boil all that down, that roughly translates to about 300 grand a unit versus a single family, which is 1.6. This is a big one. Everybody always asks me, aren't you worried about a recession? What about this? What about that? A lot of people that had their portfolio go through the last real estate debacle, so to say. Even when real estate prices tanked, rents went up. That is a wonderful, wonderful constant that comes to owning any kind of income property, but specifically, multifamily properties, is when times get tough, rents just stay steady. So I always like to give the example, your numbers are going to look the worst on the day you bought it because it only goes up from there. As well as cash flow, of course, that's a pretty straightforward translation. Rents go up, your cash flow goes up because your note is already being taken care of, your utilities are already taken into account. This is a big one. This is a very big one. This is actually one of the reasons why I initially was so passionate about multifamily real estate so many years ago in college. Less competition. With growing up in the South Bay area of Torrance, PV, Hermosa, there's a ton of competition. And because it was kind of getting into different styles of investment, you look at people who are flipping, short-term rentals, all kinds of stuff like that. When you start getting into bigger size building, you get less competition, merely from a matter of not as many people know how to fully capitalize upon these deals. And believe you me, I'm going to give the basics today, but there's definitely a lot more than just the basics to understand one of these deals. But long and short, less competition. The opportunities do exist. Is definitely a big one. There have been quite a few transactions that I've done this year locally where you see these amazing deals. Well, they're only deals for about 48 hours, of course, because they get contracted on, but they do exist. They're out there. And I'm actually going to be going over another property that I personally did write an offer on. We didn't end up contracting. I'll give you the full story later on, but it was a property that I had personally applied for one of our Marshall Reddick loans and tried to get the deal on, but didn't pan out. But it's a great case study that the opportunities are still out there. And equity gain. I think that's the biggest factor that I really wanted to give the example on today, is the equity gain in the property. I know we're going to be talking preliminarily about the basics. Cap rate is, I would say, the simplest way to translate an income property. And there's much more: cash on cash, ROI, IRR, all those other fancy 3-letter buzzwords that people use to rate if it's a deal or not. But capitalization rate is the easiest way to translate it to everyone. Okay, acquisition prices for 3 to 8 units. Again, this is kind of a broad stroke. There's going to be stuff that's less, there's going to be stuff that's more. But this is what we see on average, or what I like to operate on average for my searches when I'm looking for these properties. Orange County, we look at a purchase price of 1 1/4 to 2 3/4. LA County goes a little bit lower because there's certain sections that are a little bit lower, and you're looking at 950 to 2.5. Again, broad stroke. Obviously there's $5 million fourplexes. Obviously I wouldn't say there's much less than 950 fourplexes, but they're out there. So give that as well, like a comparable from the price point, but cap rate is what's a little bit more important. We see stuff trade hands in Orange County at about a 3 cap, and the cap rate is lower. That means it's a more luxury properties, so to say. So even stuff on, closer to the beach, downtown Huntington, on the peninsula, South County, you're looking, sometimes you even get sub 3. And it goes all the way up to a 4.5 cap if you're in a lower class neighborhood, maybe like a B or C class. And LA County is probably right about the same point. The cap rate goes a little bit higher for a little bit of the less, more lower class neighborhoods, so to say, like a C class, a low C class property is going to be a higher cap rate, probably 4.5, 5%. And again, this is for stabilized assets as well. I want to pay extra special attention to that. So when the asset is performing, this is what it should trade hands for. Capitalization rate. Again, I'm sorry if there's people who actually know a little bit about investing, but we're going to go over the super basics for those who don't really know what a cap rate is. Pay extra special attention because it even took me about half a semester to figure this out. It's a simple mathematical equation. Your capitalization rate is your net operating income divided by the current market value. What that looks like on paper is cap rate formula can be used to assess value. Desired cap rate, it's your annual net operating income divided by desired cap rate equals value. So you can actually do cap rate reversion is the official name for that transaction, where you can take the average cap rate of the neighborhood, divide it by the NOI, or the other way around rather, and you'll get the value. So here's what I was talking about, how it pencils out. Okay, so again, stick with me with this one. We're going to be looking at a couple spreadsheets today. I'll take it, nice and easy so we can walk through all these line items step by step. This is not an LA property. This is probably I think this is actually a deal that the private lending team underwrit, which is a 3-unit building. We're looking at an average annual rent or gross annual rent of $35,400. Vacancy factor, that's always important. Always account for vacancy as a real estate investor. Takes our total gross effective income to $32,568. All your operating expenses, so same thing you'll have with any other investment property, taxes, insurance, utilities, miscellaneous maintenance, leasing, so on and so forth, for a total of $12,293. So what you do is you take your 35 grand, or pardon me, your 32,568, subtract your 12,293, and you get your net operating income. What that means is before your loan, before anything else, that doesn't get factored into your NOI. You're just taking your gross income minus your actual expenses. Okay. Again, here's that formula, pretty much boiled down for you. 2275 over 6% cap rate. And that's how you get your cap rate reversion, which translates to $337,917, and that's the value of the property. What's wonderful about income property in general, or multifamily property, is that you can use this formula always. This formula will always be true. You can find a commercial lender who will lend to you on this property with this equation. It's no discrepancies, it's no ifs, ands, or buts about it. You go cap rate reversion, that's the value of the property. Again, properties can be valued by average neighborhood cap rate that properties trade hands at. What that means is, they take the average of what properties are trading hands at. Like, again, the neighborhood that I live around in Huntington Harbor, the multifamily properties generally, if they're operating, if they're stabilized, trade hands for about a 3.25 to 3.5 cap. Reason being is because it's a very stable asset. It's something that rents are forever and always going to go up. It is an asset that many people want to own because it's an A-class asset, great high demand, very qualified tenants, people who are willing to pay $3,600 for a 3-bedroom, 2-bath, and $2,600 for a 2-bedroom, 2-bath. Just good, stable A-class assets. Each county, city, and area sells at a different cap rate. Now, what that means, like I said, whereas the neighborhood that I sell real estate in, or I like to sell real estate in over by Huntington Harbor, is 3.25, 3.5 cap. Now, say the example that I'll be showing you later, the building that I wrote the offer on, that neighborhood trades hands at a 4.5 to a 5 cap, mainly because it's about a high C, low B area. Okay, so you can kind of go broad strokes on maps, but what it really boils down to is, I'd say, zip codes or different areas of town trade hands at different cap rates, and those have just been either established over time, or you can take the market average of what things are trading at cap rate wise, and those come out in all kinds of quarterly reports or wherever you get your real estate investment information. We stay up to date. It's very easy as well. You can just reach out and ask us what the different places trade for at cap rates, or we can just analyze properties when we're shopping and go find it out. Oh, these are the other metrics that I wanted to talk about. Cash on cash is cash flow divided by cash invested. Annual ROI is total profit divided by investment capital divided by years held. Variable expenses, as we were talking about, are important things to take into account. Income before variable, cash flow after variable, so on and so forth. We're not really going to go too much into those today, but I just wanted to let you know, a lot of people, they tell me after the presentation, what about the other ones? Well, we're just talking about cap rate today because we're keeping it easy. If we were going into the full analytics, we'd be ripping through my 10-page spreadsheet so we can fully understand why this is a good deal. So today we're just doing cap rate. Okay. Here is something very important, something that we like to get out of the way right up front is getting to know you. I can't tell you how many times, we do these webinars and somebody says, I'm interested, and then, we don't have that same close personal relationship. And I say, hey, look, there's a property coming available, and they don't know that when that comes available, you got to be ready to go. You got to be pre-approved. You got to have things lined up because when a deal hits the market, a deal hits the market. Same thing with off-market deals as well. Believe it or not, sellers change their minds sometimes. And when they present you a deal for a really good price, and I go to present it to an investor and they don't reply to me for a week or two because they don't understand how the transaction works, they don't know what's going on, that deal could be gone. Also, how do I find these properties? This is also a very important part of working with us here at Marshall Reddick is how we get these deals. All right, buyer-seller representation, buyer-seller agency agreements. That's what I'm talking about is, if we're going to start putting in hours and hours of work for you, come in, say hi, let us buy you a cup of coffee. We want to get to know who you are, come to an understanding, and make sure everybody knows that we're working as investment advisors for you. One-on-one consultations. Again, please come into the office. We're located on MacArthur Boulevard in Newport Beach over by John Wayne Airport. A lot of people who are attending this webinar are local, and I actually am meeting one of you next week, so look forward to meeting you, Jeff. Anyways, you can also get to know the private lending and property management team, and those are also very crucial parts to this equation. Again, with these multifamily investments, they will not be profitable if you don't have the teams there to support you. That was one of the main reasons why I myself joined Marshall Reddick, was because the value in having property management, private lending, as well as brokerage all under one roof is kind of like a license to really just be a millionaire. It's so easy when you have everybody under one roof, because when there's an issue that arises, either private lending or PM, I just pop my head up from my cubicle and yell over and say, hey, what's going on? So come meet the team, come see who's working for you. Again, be prepared. The need for speed is of the utmost importance. When a deal pops up, you need to be the first person to call, first person to react, first person to have your finances all lined up, and I should be able to have the confidence and say, my client will buy this property for X amount of dollars. Please sign on the dotted line. Something else as well is, come in and so I can get to know you, so I know what neighborhood we're looking in. Bird dogging deals is what we do. Question a lot of people always ask as well is, how do we find these 3 to 8 unit properties? And I say 3 to 8 units because that's what I mostly look for. That's what my marketing campaign is set towards. That's where I spend a lot of my time, effort, and energy trying to reach out to these landlords. Again, how do I find them? Direct mail. It's kind of old-fashioned, but it's very true. I've got about a $4,000 letter machine that I bought and serviced that sends mail out to my selected markets about twice a month. So I print those, put them in the machine, hand sign, hand letter, hand stamp, do the whole nine, all the old school stuff that really gets down to brass tacks. Now, that's not all we do, of course. We've got all other kinds of marketing techniques. We find some deals as well by reaching out from the property management standpoint. Sometimes when somebody contacts us for property management, they say, can you fix this? Or better off, get rid of it. And those are sometimes the deals where somebody's headache, where they want to get rid of it, they can move up to a different asset, and then we can sell that to somebody who's willing to take on a headache. Different strokes for different folks. There's a different kind of investment for everyone. Networking and referrals. I can't tell you enough how many clients I've been referred to from either past clients or professional networking events of people who are just looking to buy investment real estate. After you do one deal for somebody and they've got a whole network, you better believe it, you got more people coming to you. And those are all off-market opportunities that gets presented to our clients first before we even list it. And previous clients, again, once you help somebody, sometimes they turn around and they want to sell the thing you bought for them, or you help them purchase rather, and they're just willing to off it because their ROI is through the roof, and it's faster for them to sell it after 8 months than it is for them to sit on it for another 4 months, and their ROI goes down. So kind of a weird translation how that all works, but again, schedule an appointment, I'll explain. Competition is stiff. I cannot stress that enough. Come in, have a relationship, understand what's going on, set my contact as a favorite in your phone so it rings through when you leave it on do not disturb. It's very important that when these deals come up, we're able to fully execute. Okay, property management. I'm going to leave this up for a split second, but you can find this on the MR website. I just wanted to put this up there because property management, as I said, is key. You can't increase your NOI if you don't raise the rents. You can't raise the rents if you don't know how to service the property. If you don't maintain and manage the property, you can't raise the rent. It's just, it's the key to any multifamily transaction. It's how you increase your NOI. It's how you increase your gross scheduled income. It's how you increase everything. More money in, higher money out. Okay. Also, we are real estate investment oriented. What that means is we're not charging extra fees, no maintenance coordination, no eviction, no setup. Any lease renewal fee is only 150. We're at a very competitive property management rate. I mean, we can get into it more, but that's not what we're talking about today. Here's just a short map of everything we manage here in California. Of course, we manage even more so in out-of-state markets, but again, today we're talking about our market. Here's an example right in our backyard. This is about 10 minutes from our office. 4-unit building in management in Costa Mesa, 421s, value add acquisition. This is a property that one of our landlords acquired, and we actually went through, raised the rents, cleaned it up, fixed it up, had some vacancies, released those vacancies, and they gained some equity accordingly. Here's what I was talking about as well, 5-unit building in Santa Monica. This one has definitely been a lot of work. I've been updating this, getting updates and information on this property. We've done some substantial renovations, 200,000 plus in upgrades. But with that, of course, comes massive rental increases as well. This landlord has owned this property for quite a while. And when we stepped in, we helped increase the rent substantially. As well as this 8-unit, 3 2-1s and 5 1-bed 1-baths. Again, a substantial amount of renovation went into this property. Remember, when you're working with us, it's not so much just the analytical side of the property. We've got boots on the ground. We've got managers. We've got, property managers and staff who are set out for maintenance and renovation of these properties. Very, very important. We're kind of doing the investor side of things for our investors. Again, more information, you can check it out on the property management page, but we are going to get into the good stuff, not the best stuff yet. We're going to start talking about private lending or loan programs. Again, a big pain point in a lot of these multifamily deals. Why is that? Because for a 5-unit plus building, you cannot get a loan if the rents are not up to par. Now I'm going to say that one more time. You cannot buy a building if the rents are substantially below market rate because you cannot get a loan on it. You cannot get a fixed rate loan on a building that is not bringing in rents. I've said it 3 times now, and I'll leave it there. That's why I've included in this form the renovation loan as well, because the renovation loan actually does work for multifamily purposes, and I know that because I've done it. That is personally, and I'll show you the other property, the big flip that we didn't contract on, but I just wanted to use it as an example. And I was going to use the Marshall Reddick renovation loan, and I'll again show you how that all pans out. But we also have a 3-year 30 at a 6.5% interest rate. Why that works? Oh, also for 4 units and under, everybody remember it is residential, so you can get a 30-year fixed loan, conventional, which is phenomenal. I like sitting right at the 3 to 4 unit mark just because of this. But you know, some people like to scale up a little more. Again, the economies of scale. When you go bigger buildings, you get better deals, but it gets a little more complicated. So I'd recommend if you're going for your first multifamily property, go for a triplex, fourplex, somewhere in a good market. And Reed Hazard is definitely the guy to talk to. He's exponentially helped us. He is also a investment owner. He understands how everything works. He is phenomenal when it comes down to that. All right. You can see more on financing at mr.com/loan programs. And this is what I wanted to talk to about as well. For qualifying for these loans, we are a non-recourse lender. What that means is we're asset-based. We don't lend according to credit score, income, qualifications. So if you've got 20 properties, your DTI is through the roof. It doesn't matter because we lend on assets. It's one of the best parts about Marshall Reddick as a lender is that we are so easy to get a loan with if the deal is there. Of course, I'm not saying we hand out free money, but if you've got a deal and the deal pencils out and there's meat on the bone, we will make that deal for you. Again, that's why we stress coming into the office as well, because we've saved many deals as well. Even if it's not a deal that you're currently under contract with one of us, if you've got another deal that you're in escrow on, you're trying to put it through, the proverbial, what hits the fan, we've stepped in many times with a private loan to kind of fix everything. So reasonable fees and interest rates and quick closing, 21 to 30 days. Private lending is phenomenal. If you're a real estate investor, you got to look more into private lending. No appraisal under 50%. That's awesome as well. Renovation, bridge, and new construction. So we do it all. Here we go. Here is just the rate sheet that I wanted to walk down with you as well, and just so we're disclosing. It's a 70-30, 30-year amortization, 1.25 DSCR, that's debt service coverage ratio. Now, again, pardon me if I'm glossing over this because I'm trying to get to the multifamily part, but this loan essentially means as long as the building is bringing in rent, you can get a loan on it. That's why it's important for what we're talking about, because you can get a loan with private money. You're not going to have to qualify for $2 million because the building will pay for itself. That's at a 6.5 interest rate. Bridge is also available, financing available for repair and upgrade, and that's what I'm going to be talking about as well. Okay. Here is what everybody wants to see, what everybody wants to hear about. This is actually a building that I sold to a good friend and client of mine about 1 year ago. It's a triplex in Old Torrance. It's right around from where I grew up. Phenomenal building. If you look, it's about a 5,000 square foot building. It's a little bit more than that, but I just kind of roughed in numbers for the sake of this. Purchase price $165. It was actually $1.625 because we negotiated some setbacks, but the building was not performing. It had 2 tenants in the back, no tenant in the front. I just like to give this example because it is what buildings look like when you acquire them. You are not going to acquire a performing asset for a deal, okay? There is performing assets out there, but just about every property that I see that hits the market has some kind of discrepancy with regards to the income of it, right? What that means is maybe one of the units is at half of market rent. That poses an issue because as per California, rent control laws, you cannot just raise them up to market rent. And that is something that you got to plan for a couple years to slowly either renovate the property or kind of get some vacancy in the building, offer them a solution, cash for keys, something like that. Again, all the stuff that property management handles. But again, here it is. This is Torrance triplex, three bedroom, 3 bath, 1,600 plus square foot units. Right, purchase price 165, current rents bringing in 76,800, NOI super low at $32,000 for a total cap rate of 1.9. Again, buying at a 1.9 cap would be a terrible idea. However, we're not worried about the 1.9 cap because with our property management team, we can take that into this. Okay, again, here's an example. Did some renovation work, cleaned it up, fixed it up real nice, okay? And here's our after number. Same building, new color. Went from blue to green. Green, the color of money. All right, list price 165, but what the biggest thing is, we moved our rents to $137,000, okay? Remember our before rents were at about 70K before, we're now at 137. Now, why is that? Because we picked the right building. The building had three bedroom, 3 bath units. We've turned over not even the full building. This is the rent after 2 of the 3. Oh no, pardon me, this is 3. We turned over all 3. Turning over the entire building, we brought it up almost double, okay? Now this building is bringing in a monthly income of about $3,200 a month cash flow. Cash flow. That's what, 36,000 change, or more than that, probably like 40 grand a year. I don't have my rough numbers calculator, but still, this is on year 2 because of all the efforts that we put in. Again, we did spend about $120,000, so it takes a little bit of change to make a little bit of change, but this is what I want to give the example of. This is a landlord that did the full run, okay? He purchased it about a year ago, slowly went through, had 1 vacant unit, renovated that unit, Marshall Reddick leased it. Okay, had a second vacancy, we renovated that unit, Marshall Reddick leased it. Had a third vacancy, did a renovation, Marshall Reddick leased it. These properties take about 7 to 12 months to turn over, sometimes quicker if you have a completely vacant building, but just account for it's usually about a 1-year turnaround. And that's just because of how these things operate, okay? You're not just going to kick somebody out because you want to kick them out. There's laws against that. And also you want to make sure to take care of all the things that need to be taken care of. That's permitting, that is doing renovation properly. That's 60 to 90-day turnaround on 1 unit at a time. I just like to say you can do it quicker, but a good estimation is anywhere from 7 to 12 months for a full turnover of one of these buildings. Okay. So again, almost double gross. Your NOI goes to 77,726, lucky 777. For a cap rate, now again, a cap rate that we're valuing by the holding acquisition price, right? So our list price, or the price we purchased the property for, 165, our NOI is now $77,700. So if we do list price divided by NOI, we get 4.7 for a capitalization rate. Okay, now, this is the other way around. So if you do future valuation through the cap rate, because I know this neighborhood trades hands for about 3.75, 3.5 cap for a performing asset, you could value this same building after, I'd say about 9 months is when the renovations were all done and we were leasing the property up. You can value the building at $2,045,000. Okay, so that's 9 months of work. You're looking at an equity gain of about $250,000. That's valid. That's true. You can get a loan for the value of this property at $2,045,000. Facts. I know because they did. They actually refinanced once everything was said and done. It actually valued at 2.1 is what they paid out for them on, and they pretty much pulled out all of their initial investment and then some. So very good investment move on this part. But here's the kicker as well. There's always a little bit of icing on top because I know he just got approval to add an ADU. That actually is factored into the $120,000 renovation budget. after rents of $168,000, NOI of 108, cap rate of 5.91 for a future value at a 4 cap. We're going to go a little bit higher because we're adding an extra unit of 2713. So check back in with me. The plans just got approved. He's probably going to be done in about 5 or 6 months, but they're going to add an 1,100 square foot 2-bed, 2-bath unit to this property. 2-bed, 1-bath, pardon me, whatever the ADU allows them to fully add. Okay, here's another example property. This is the Huntington Harbor building that I mentioned earlier. This is a property that we had sold in January of this year to one of our clients. And this is the long and short of what this building translated to, okay? Here it is, 16842 Hoskins Lane, Huntington Beach. Purchase price, 1.8. Current rents that the building was operating at was $86,400, which pans out to a net operating income of $37,028 for a going in cap rate of 2.06. Again, don't let a low cap rate on acquisition turn you away. A lot of first-time investors, they look at, oh, what is it doing right now? What is it performing at? And that's not what we try to get stuck on thought process-wise, because what was really appealing about this building was the bed bath count and the square footage of the building and the proximity to the ocean. So this building has really turned into a great asset for our clients with a $75,000 budget for renovations. We're looking at after renovation rents of $130,200. And that's where it's at right now. As I had mentioned, we're about to lease the 3rd unit, the 1-bedroom, 1-bath. We're going to be listing that in the next day or so. And then we still have 1 unit that's got about $400 or $500 of wiggle room, so to say, to increase the rents. Of course, we're not just going to hike it up because she's a wonderful paying tenant, but there is still upside in the building. But we're going at a 130 after rent, $75,000 NOI for an existing operating cap rate of 4.17. Now I know this neighborhood trades hands for about a 3.5 cap, like I was giving an example of before. So you can effectively future value this fourplex at $2,147,000. I know for a fact that fourplexes trade hands for 2.2 in this neighborhood, but I'm just using this as an example of cap rate reversion. This will always work. If they wanted to go get a loan, they would look at the cap rate of this neighborhood. They would value the property at roughly that. Although 4 units, you can do comparable analysis. So if the comparables are a little bit higher than the cap rate, you can also work with that. But it will always trade hands at about a 3.5 cap, a little more, a little less. And that's the property value you can get. For a net equity gain of this property over 8 months, I know because January and we're now in August, of $347,000, okay? If you actually put that into a spreadsheet for a flip, looking at your ROIs, that's substantial. That's a pretty dang good ROI. Also a wonderful holding asset because as you can see, they're cash flow positive on month 8 of, roughly about $400. So not as much as Cabrillo. There wasn't as much upside in this one, but again, this is A-class bordering luxury real estate. And if anybody here owns multifamily real estate, you know that if you buy a value add acquisition, if you're stabilized on year 1, that is awesome. That's really good. So we've got a pretty good track record. And here are some photos. When we renovate these fourplexes, it's nice, but it's nothing special. We've got wonderful, just clean walls, ceiling fans, recessed lighting, LVT. Oftentimes we look for buildings that don't need windows or any kinds of issues like that. Just bringing everything up to a wonderful tenant expectation standard so that we lease these properties quickly and oftentimes for above asking price. We're oftentimes leasing on the average or above average for what units are bringing in this neighborhood. Why I say that example is because this one actually increased the value. We were the highest 2-bedroom, 2-bath unit to lease in the neighborhood. Fact. which is pretty crazy. But we're doing it. It is what it is. Okay. Now, this deal is going to take some time. This is a property analysis using a Marshall Reddick loan of a Gardena 5-unit building. Again, this is a building I applied for a Marshall Reddick loan. I personally was going to acquire. Reason why we didn't is because there was some tenants that were squatting and we didn't want to buy a lawsuit. So that was, you know, the legal fees when in a courtroom can be more expensive than your ROI, especially when you're trying to turn a building around quickly because your money needs to make you money fast. All right. It's actually still in the market if anybody wants to look at it. This is a little bit heavier of a lift than we generally do as property managers here at Marshall Reddick, but it's definitely something that, you know, for the right situation, we can make these things happen. So, and again, I would not advise purchasing one of these properties as a first-time multifamily investment at all. This is definitely something that takes a lot of moving parts, a lot of knowledge and know-how, a lot of, you know, not only legally, but maintenance-wise and permits and all kinds of stuff. But essentially, long and short, we're flipping multifamily. Okay, what that looks like, purchase price, $1,099,000, current rents, 0, NOI 0, and cap rate at a 0. Now, again, like I said, there was tenants who were in the property, nobody was paying rent, and it was just kind of a headache of a building. So I just kind of thought it was funny to throw it in the spreadsheet. Wonderful monthly income of negative $6,300. Okay. I'm going to leave this up for a split second, and I'm going to explain what this is and how this roughly translates, because this is using, as I said before, a Marshall Reddick loan. That loan is a 90% loan, 10% down payment, 100% renovation cost loan. Okay? Now, I could go back to the rate sheet, but I advise you to go back and check it out from the Marshall Reddick website. We do tons of loans with varying down payments. This loan specifically is on the pricier side. It is a 12% loan, but even still, for hard money, that's extremely competitive. If you were to shop around, I know because, you know, before I was using loans like this and they were at 14, 15, 16, 18% sometimes. They're very expensive. Marshall Reddick has a great program, not only in my personal opinion, but that's why I'm here and that's why I use Marshall Reddick loans. They're also very easy. Again, they're non-recourse asset-based loans. As long as your deal is a deal, we will lend on it. Okay, let's get down to brass tacks. Purchase price, $1 million. I know it was listed $1,099,000. We came in at $1 million. Months held, 8 months. Rehab cost, $250,000. Now, we had a little bit of our money in the pocket to put into the loan, so that wasn't the whole, you know, chunk of it, but just for the spreadsheet right now, I threw it in there like that. Property taxes are low on there because it's averaging over 8 months. It's prorated. Same with insurance, utilities, and everything else. So that right there is our total fees and expenses that we were talking about that cuts out of our profit for a total investment of $1,276,000. Okay, total amount borrowed, 115, interest, yada, yada, yada. So let's get down to brass tacks. We're doing a 90% loan, 10% down payment, 100% financed. Cash to close, monthly payment, $9,000. Now the monthly payment again is IO, interest only. So that's still something that needs to be paid out. But here's the most important part, why I wanted to use this property as an example. Now, a 5-unit building that operates like this, you cannot get a loan on, flat out. It does not have any performing assets. It doesn't have any income. There's no gross, there's no net, there's absolutely no income at all. So in order to get this building to a point where I could even get a loan on it, and I was planning on refinancing on the back end and holding the asset, you have to bring it up to rent. Again, this is an extreme example of a situation that a seasoned investor would use to turn these multifamily assets from non-performing to performing, without having the need of having $1.25 million in your bank account to do the deal. That you can get a loan on them, that you can do this situation. Because once the building is said and done on the back end, it was going to be bringing in about $10,500 a month, which would do a cap rate reversion at $1,750,000. And that's at about a 5 cap, I believe, is what I averaged it at, which is very high for the neighborhood. Buildings would trade hands for anywhere from 4.25 to 4.5 cap, which would value the building at $195 to $2 million. But we always like to operate conservatively on all of our metrics, no matter what. We operate on relationship based, and we would rather sell a deal that is actually a deal than oversell a deal and have everything go south. Not only for our client's sake, but for our own personal sake, because we want to make sure that we are treating our clients with the best level of respect, because we do get a lot of investors who are coming in and this is their either first multifamily deal or first investment deal in general. And it just comes from a good place. This company was built on education. Marshall Reddick, Marshall Reddick's a guy, we get that asked a lot. He's a wonderful, wonderful man. We just celebrated his 80th birthday. He started off from the point of education. He was actually a college professor. But we just like to operate from a conservative standpoint. Anyways, getting down to it. Facts and questions. Again, if anybody had written down any questions, I will get those answered afterwards so that everybody can see, we can get those questions answered for you. And I wanted to go through the FAQ as a couple general questions that we get asked often, and I will answer them. Here we go. I already own a multifamily. I self-manage. Can Marshall Reddick help? Yes. Yes, Marshall Reddick can help. I can't tell you how many times we've seen multifamily assets that get inherited, or they get purchased, or they get tenants who dig their heels in, especially in Los Angeles County, and it starts causing some serious income issues, because at the end of the day, your building does have a note, it does have a financial burden on it, and we always want to keep our NOI above that mark. Yes, Marshall Reddick can help. Whether that's through management and help stabilizing your asset, or through 1031 exchanging into a different asset. Sometimes continuing to own an asset when it's not a smart move, and when you could sell it to somebody else, and as long as everything's disclosed, some people are more into playing in the mud, so to say. So whereas like this Gardena asset that I would have acquired, I'm very well versed and have a great team behind me, and knew that we could have whipped that building into shape. But there's just some things that we weren't willing to touch, and somebody else is. So when you have an asset that isn't performing or isn't doing what you want it to do, sometimes it's best to either sell it and buy another asset in a better neighborhood, or have Marshall Reddick Property Management step in and hopefully get that figured out. I'm scared of rent control. Is multifamily safe? I can't tell you how many times I hear this question. This is a big question that a ton of people ask. California rent control went into law some years ago. Nobody really knows what's going on where, and they're updating it every couple of months. Especially during COVID, there was always some new update with rent control and this and that and yada yada yada. We stay up to date on all of that, especially because we manage properties in these areas. It is very important, legally as well as profit-wise, to understand these laws. Multifamily is safe. Owning real estate in Southern California is safe, as long as you cover all of your bases and you have a good property management team to cover those bases for you. You can never expect a single landlord to understand everything fully. That's why we have a fully staffed team of people whose job it is to stay up to date on these issues. I can't, again, stress it enough. Multifamily real estate is not easily doable if you do not have a property management team to fully navigate the issues and laws regarding tenancy. I'm contemplating a 1031 exchange. Can I exchange a single family residence into a multi-family home? I get asked this question a lot, mainly because the verbiage in the 1031 exchange is exchange for like kind. Now, of course, that would be very confusing, but like kind only means you're selling an investment and buying an investment. You could sell a single family residence and buy a duplex. You can sell a single family residence and buy a fourplex. You can sell a condo and buy a 100-unit apartment building. Well, not really, like the finances wouldn't quite line up there, but you get my point. You can do that all day. And especially with a lot of us living in Southern California, I've had clients before, hey, I just inherited mom and dad's house. Luckily, they lived on the peninsula and their place is worth $4 million. What do I do? Well, Mr. and Mrs. Seller, we can take that and translate that into 8 units. That's going to earn you a 6-figure income. You can retire at 32. You can do that and you won't even have to pay taxes on it. It is 100% able to do it. If you have more in-depth 1031 questions, I will actually be doing another webinar on 1031 exchanges next month. Or you can reach out to me directly if you have a more pressing 1031 question, and I can connect you with the person who will be giving the majority of that webinar, and they can answer any and all of your questions. So I'm concerned with the market's current status. Should I wait to buy? Oh my gosh, this question, I didn't write these questions actually. There was somebody else who wrote these for me and was trying to trick me on them. This is definitely an on-the-fly question, and I can give you a very straight answer on this. You should not be concerned with the market's current status. You should be concerned with what rents are doing. You should be concerned with what rents do during an inflationary period. Market prices are going to fluctuate. They go up, they go down. What's very important in this situation is the fact that interest rates went back down a little bit and they're going to continue to stay down. So what you really want to do is you want to lock in a sub 6 or sub 7 interest rate, whatever they're fluctuating to for multifamily investments right now. And you want to get your asset cash flow positive, because I can assure you over the next 2 to 5 years, prices will fluctuate either up or down. Nobody can estimate, but rents will go up substantially because they just printed a ton of money, and cost of living, your biggest metric in cost of living is your rent, or however that pans out. So rents have been and will continue to go up at a very acute rate. All right, there's my smiling face. Come see it in person. Come meet me. Come set up a meeting. Feel free to contact me. You can shoot me a text right now. Don't call me right now because I'm teaching you guys. You can shoot me an email, or you can go to marshallreddick.com/consultation, where you can get a hold of me. Thank you again very much for attending this webinar this evening. We're going to be ending about 5 minutes early, so do me one favor, and if you're living in beautiful sunny Southern California, get outside and get some of this wonderful summer air. I'm going to leave this up for everyone so you can write down this information. You're probably also going to be getting a follow-up email, all kinds of information. I'll also be reaching out to all of the attendees sometime in the next couple days. Save your questions, write them down now. We'll be able to help you out. Again, thank you very much for attending, everyone. I look forward to helping everybody acquire and grow real estate portfolios. I'll talk to you soon.